Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Vikram Malhotra, Senior Analyst and Co-Head of U.S. REITs Equity Research at Mizuho Americas, to discuss where the opportunities are and sentiment in the real estate space. Vikram, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Excited to be here.
Let's talk about e-commerce. What are some of the trends that you're seeing there?
So e-commerce has definitely been a boon for industrial warehouses, names like Prologis. We're actually seeing a pullback in demand after what I'd call a 2-year pull forward. Amazon and other players grew very rapidly, almost like Amazon grew 50% during COVID. So we're seeing a normalization of demand, normalization of fundamentals. Some regions in the US, like parts of California, actually decelerating surprisingly a lot quicker. But I would say, stepping back just broadly across real estate, the fundamentals for e-commerce and warehouse still screen relatively attractive. We're still seeing you and I want to deliver goods. We want to get 1-hour delivery. Warehouses have to be close to us. So very, very strong demand trends.
And of course, let's talk about office and return to work, hybrid strategy. I mean, we know that specific sector within real estate is struggling.
It's interesting. About 2 years ago, I published a note called Know When to Fold. Essentially, the office REIT thesis was centered around remote work and also cyclical risks, the technology job losses. So far, we've seen probably a lot of small companies give back space. Today, we're seeing larger companies give back space, saying, hey, we needed 5 floors. Now we need maybe only 3. Let's use New York as an example. Pre-COVID, we had 8% vacancy in office. Today, we have 15-16% vacancy. I want to venture to say going forward, we probably will never see vacancy dip below 10. So there's some structural issues in the markets where high vacancy means low rent growth, low cash flow. And that is now coinciding with what we know as an economic hard times on us, where jobs are being cut and vacancies are just going up. So it's fairly hard for office REITs. Some would say today it's priced in. We like selective names like Boston Properties and Kilroy, very high quality portfolios, good balance sheets. But overall, the sentiment around office REITs still remains very, very negative.
And Vikram, you point out in your research that cities like San Francisco, as an example, longer term are most likely hampered, but there are some smaller metropolitan areas that could potentially recover.
That's very true. So we did work on 13 different cities. We try to figure out which markets will be structurally hampered. You're right, San Francisco vacancy today is 40%. Never seen those levels of vacancy. New York as well. But then there's some Sunbelt markets, Austin, for example, or Raleigh and Nashville, where we think structural vacancy will dip down below levels from which you see pricing power. So cyclical risk for sure, but long term, we would like the positioning of, Austin and Nashville. And I think that'll change the way REITs invest. It'll change the way private investors direct their dollars. You probably see a lot more money, even from here on, going towards the Sun Belt and some select cities. But certainly, you're right, there's going to be a market of have and have not.
How do you play the silver tsunami? In other words, the aging baby boomers, they're going to need care and facilities.
It's a topic, very close to me. And so let me just set the stage. The next 5 years, senior population growth, essentially seniors over 80 years, are going to be growing at 4 to 5% per annum. That's coming off of the last 5 years where we were maybe 1 to 2%. So there is definitely an opportunity for what I'd call healthcare REITs that cater towards these seniors. Senior housing, as an example, these seniors need, when they retire or they need to move into a seniors facility, they go to an independent living or an assisted living. Welltower is our top pick in that space. They have a high quality portfolio across the US, also very high quality services. And I think the party to some sense is only getting started. I know Welltower has run up, but if you think about over the next 2 to 3 years, there are 3 aspects I really like about the senior housing space. Welltower and then Ventas in addition, we're overbuy on that name. Number one, the organic growth opportunity is very, very attractive. We're seeing 15 to 20% year-over-year operating income growth in their seniors housing segment. I think that's sustainable into next year. And it'll be hard-pressed to find REITs where you see that level of growth. So very strong internal growth. Externally, a very lucrative opportunity. There's over half a $1 trillion of real estate assets that these REITs can go after. They do have the balance sheet. Welltower in particular, I sense, will be very aggressive to take advantage of some distress in the opportunity. But then thematically, I think Welltower is doing something very unique. They are essentially creating their internal platform to try to manage these senior living facilities. That has margin implications, but also lower CapEx. So somebody looking at themes over the next 2 years, I think seniors is a great way to play it. You can express it on seniors. The other way to express it is, one, I would say skilled nursing facilities, but two, to some extent, as seniors age, there's probably new drugs and new medicines to be had for the seniors as well. Life science is a perfect space as well. So I would highlight healthcare as a segment. I think will do very well over the next decade.
All right. Appreciate the insight as always, Vikram. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much, Jill.